I'm Bill McWilliam, president of Cascadero Copper, CCD on the TSX Venture Exchange. Cesium is one of the world's rarest metals with a growing industrial demand. Drilling is underway on our Tehran property in Argentina to prove up a cesium resource. Cascadero's patent-pending leach process has the potential to make Cascadero the lowest cost supplier of cesium in the world. Visit our website, cascadero.com, or phone us at 604-924-5504.
You're listening to HowStreet.com radio, available online at TalkDigitalNetwork.com. Welcome to HowStreet.com radio, the online source for market opinions. Here is Jim Goddard.
My guest is Drew Zimmerman. He's a portfolio manager at PI Financial in Vancouver. Website, PIFinancial.com. Welcome back to the show, Drew.
Thanks for having me on, Jim.
Oh, boy, are people questioning the market right now. We had a similar downturn in our markets at the start of this month, just like January 25th, 2 years ago. And then the question is, well, has all the dead wood been cleared out? And are we all in for good times, or should we be cashing out and waiting for a bigger plunge? Your response to all those questions.
A nice, easy question to start. Thank you. I appreciate it. Yeah, we've seen just incredible volatility. I mean, this year compared to 2 years ago, January started going the other way. January started up with an incredible run. I mean, through the first 3 weeks, if you annualized the Dow returns, we would have been up 244% on the year. I mean, you just know that's not going to continue for the year, because that would just be incredible. I shouldn't say you don't know that's going to happen. It would be very unlikely. But with the recent plunge that we have had, I mean, we've seen point moves, not percentage moves, but point moves that we've never seen before in the market. So, rightfully, everybody gets a little panicked, gets a little scared of what's been happening. This time, everybody's really looking. I mean, not this time. I feel like every time we see these sell-offs, everybody looks for something to point to, somebody to blame, something that went wrong. The scapegoat this time tends to lead toward the short volatility traders. We've seen some of the ETFs or ETNs that will actually have to wind down because of the events of the past couple of weeks. So they are taking the brunt of the blame, if we want to put it that way. Is it over? Is it safe to jump back in? I mean, very difficult to say. The market has again stayed volatile. We did make a bottom last Friday, sort of midday, turn to end up on the day, and have been up through this week again. And again, just continued volatility. I mean, we're seeing regular 100-point moves in the S&P or 1,000-point moves in the Dow or close to that sort of measure. But the one thing that really caught my eye through the sell-off initially was just how concentrated it was in the stock market, that we weren't seeing those type of swings through other asset classes, currencies, precious metals, interest rates. At the same time, we did see some of those markets start to move on the big sell-off on Monday. But we are seeing some volatility in those other asset classes, but not to the degree that we saw it in the stocks. So some of what I'm looking at tells me that, we really may have shook out some weak hands that were, over-leveraged and overdone on the short volatility trade. The upside volatility also scares me a little bit to say, okay, I think we can consolidate and be productive in market prices going forward. The rate at which we've come back off the lows is almost too fast. But the way that I'm looking at markets as a whole, I mean, the last couple of days, people have definitely looked to step back into some risk trades, which can be a positive for the market going forward.
Well, it's pretty hard to look back at history and see how you should deal with this market, because we've never had a stock market that over 9 years has had a continuous rise.
Exactly, and we've never had central banks around the world pump billions or more correctly, trillions of dollars into the economy. And now, through the last phase of the U.S. cycle here, have had more fiscal stimulus, as well as U.S. deficits thrown on the fire. So, if you look at the interest rate space, we've now got the U.S. 10-year at 2.9 or over 2.9%, where we were only at 2.3% 3 months ago. So, the interest rate space has not absorbed the volatility that we've seen in the stock market. Rates did back up briefly when stocks were really selling off, but now they're out at new highs again. And again, there's more going on in that space with central banks aiming to tighten, so there's less of a bid in the bond markets, as well as on the supply side. There's more issuance coming as the U.S. debt gets bigger, and again, it will be harder to service as rates move higher. So that rate space, again, it's tough because it does have its own dynamics, but the way the interest rates have moved give me an idea that maybe some of the worst volatility could be behind us in the stock market. But I definitely say that in a cautionary tone.
We'll have more with Drew Zimmerman right after the break.
Cypress Development Corp's flagship lithium project is located just east of Albemarle's Silver Peak mine in the heart of Clayton Valley, Nevada. A 12-hole exploration drill program for lithium-enriched claystone on Cypress's 100% controlled properties is now underway. Cypress Development Corp trades on the TSX Venture Exchange, symbol CYP, the Pink's CYDVF, and on Frankfurt's C1Z1. For more information, please visit our website, cypressdevelopmentcorp.com.
Glance Technologies owns and operates Glance Pay, a disruptive mobile payment technology now live in 16 cities in Canada and about to launch in the US. With revenues up 664% in the last quarter, Glance Technologies has the potential to be a worldwide leader in an industry projected to grow to $1.3 trillion in 3 years. Glance Technologies stock symbols are GLNFF in the US and GET in Canada. Find out more at glancepay.com.
Welcome back. We're speaking with Drew Zimmerman. Drew, given the volatility on the markets, do you think the central banks will continue with their, I would say, declared interest of putting up interest rates a few more times this year?
I don't think they change their tact at all. I think this has been a market that they may have viewed as getting ahead of itself, whether they came out and said that directly or not. And that a correction is healthy as long as it's not a prolonged sell-off. I think it would take quite a move to have, the Bernanke put, as we used to know it, or what QE became known as. I mean, for Powell to come in, the new central banker at the Fed, to do something similar, I think would take a much bigger sell-off in the stock market. So I don't think they're going to change their tact. If we look back at when stocks did start to roll over, the Friday was the first bigger jump we've seen in wage pressures. That's something that the central bank's been looking for. Today's volatility was also sparked by stronger than expected CPI numbers. So if inflation is starting to come around, maybe the central bank not only will stay on track, but could possibly even be moving faster than we would have thought just a couple of months ago. And that itself may be what is adding to some of the volatility that we're seeing. Definitely in stocks, definitely in some of the other asset classes and currencies on which way the currencies are moving.
So will interest rates be the key factor moving markets across asset classes?
I do think interest rates play a very key role, although just as I was talking about, the inflation picture that we're looking at will be a key driver, and maybe a key to how far interest rates can go. Can we get to 3% on the U.S. 10-year, or can we get to 3.5% if we start to see inflation go and the Fed, get behind the curve, so to speak, and have to chase a little bit and push rates up a little further. It's a key aspect, and I definitely don't want to underplay that. However, also we're seeing different sort of momentum swings in this market, where once the market starts going in one direction, it builds on itself rather quickly and really drives markets. So I always look at different markets, and I've got key drivers for each different asset class, and I'm definitely seeing some divergence away from some of the regular key drivers. One of the key themes for me has been the way different asset classes have been driven away from some of their normal influencing traits by an excessively weak U.S. dollar. And that's something that's obviously got my eye today, the U.S. dollar weakening quite sharply on the back of increased inflation in the U.S., which to me is a little surprising to see. But again, it's given us a strong move higher in gold today.
We'll have more with Drew Zimmerman right after this.
Hi, I'm Douglas Mason, President and CEO of Magnum Gold Corp. Inc., MGI on the TSX Venture Exchange. A 2015 drill program on the LH property intersected high-grade gold, including 16.9 meters of 13.58 grams and 11 meters of 20.66 grams per ton gold. A follow-up drill program is planned to further evaluate previously identified subsurface high-grade gold mineralization. Please visit our website at magnumgoldcorp.com.
Keep informed. Receive our weekly recap of thought-provoking articles, podcasts, and radio delivered to your inbox for free. Sign up for the HowStreet.com weekly recap on our homepage, HowStreet.com.
Welcome back. We're chatting with Drew Zimmerman. Drew, with stocks having such a strong bounce from Friday's lows, why is gold performing so well?
I mean, the reason I think people are really wanting to get into gold over the longer term is a hedge against inflation. That makes a lot of sense. You don't want to have cash that's going to become a diminishing asset. You would rather have a hard asset itself, like gold. So when we have inflationary numbers pick up like we did have this morning, that puts a bid into the gold market, where I see the larger run up in gold today. I mean, we had a very significant, call it a $40 range in gold today, was more U.S. dollar weakness. And I say that because we do have interest rates moving up so quickly and continuously. They really haven't slowed even through some of the equity sell off. So when you have interest rates, nominal interest rates moving up so quickly, and inflation, starting to pick up, real rates are still moving higher, and real rates work against gold because, if you're a paper investor, say, you want to be getting a coupon for something rather than, no coupon that you would get in holding gold. So having real rates move higher now, I still think is working against gold, but what really is working for gold is obviously the weakness in the U.S. dollar. I think that's been a big part of gold's run over the past 2 months, especially, again, from that mid-December turning point where gold really ran higher as gold sort of got excessively weak, in my language. So again, I think the key thing will be inflation over the longer term, but near term, I think it's all about the U.S. dollar that's driving gold higher.
What about the little old Canuck buck? How's that going to do in this kind of atmosphere?
Again, I'm going to say it's all about the U.S. dollar. I know as Canadians we are proud of our Canadian dollar and think that we have a big influence on it, but the recent market environment, I would say, we're just the opposite side of what the U.S. dollar is doing. I mean, if you put a chart of the euro and the Canadian dollar, I mean, the Canadian dollar just seems to be chasing the euro around these days, which again would be the reciprocal of the dollar index because the euro is such a big component of it. So I definitely think we've got other issues that will come to the forefront once the U.S. dollar maybe calms down some of its volatility and becomes less of a driver. I think crude oil is still going to be a drag on the Canadian economy. Not only WTI prices coming off from $66, we had hit 58, but bounced a bit today. But also the fact that Canadian crude is near a $30 discount to WTI, so a negative for Canada. The NAFTA negotiations, a negative for Canada. Again, some of the infrastructure pipeline issues that Canada is facing between the provinces, an issue, and a central bank that I think is more worried about the debt load of Canadians, and in that language sort of setting the bar higher for any further rate hikes than I think is currently being priced into the market. So we see 2-year interest rate differentials with the U.S. again working against the Canadian dollar as well. So again, the key point right now, all the focus tends to be on, what is the big dollar, what is the U.S. dollar doing? And as that calms down, I think we start to look at a few of the other key drivers of the Canadian dollar, and I think they're a weight for the Canadian dollar going forward. But at the same time, this U.S. dollar weakness can't be, taken out of hand. If the U.S. dollar were to make new lows for the year again, more than likely the Canadian dollar continues to do better. But again, no fault on our own there. But it's all about the big U.S. dollar in my mind.
Drew, thank you so much for chatting with us.
Thanks for having me on today, Jim.
My guest has been Drew Zimmerman, Portfolio Manager at PI Financial in Vancouver. His websites, pifinancial.com and polarfuturesgroup.com. You're listening to HoweStreet.com radio. Questions can be emailed to info@HoweStreet.com. I'm Jim Goddard. Thanks for listening.
Comments made on HoweStreet.com radio are an expression of opinion only and should not be construed in any matter whatsoever as recommendations to buy or sell any financial instrument at any time. Available online at TalkDigitalNetwork.com. HoweStreet.com radio is a production of Howe Street Media Incorporated.